Welcome to Investors Insights, episode number 139. Today we will be discussing OPEC versus fracking. Will we see the dollar get stronger? How are we looking at interest rates and how that can impact your portfolio? And if you like what we have to say, then don't hesitate to let us know. At the same time, if you don't like what we have to say, don't hesitate to let us know. I encourage you to connect with us also on Facebook, Twitter, and LinkedIn. Links are on our blog. So let's jump right in.
I'm Greg Powell, and this is Investors Insights.
You're listening to Investors Insights with President and CEO Greg Powell and the Portfolio Strategy Team at 5 Plan Partners. 3, 2.
We've got a lot of topics to cover today. Morning, gentlemen.
Morning.
A lot of good discussion this morning. So a lot of things going on, kind of at a pivotal year-end point here as we're winding up the year. So, Bobby, let's start with you. Let's talk about last week, beginning of this week. Light week on the news this week, but a lot going on.
Yeah, so last week didn't disappoint. A lot of information came out. On Thursday, the European Central Bank disappointed with the amount of stimulus that they came in with. Expectations were for a lot more, and the market traded back on that news. On Friday, the jobs report was great. I mean, there's a big improvement. 211,000 jobs were created in November, according to actually the expectations were 190,000.
Right.
And so the market rallied big on Friday, and so that's really good news. So it looks like the Fed has the ammo they need to raise rates in December next week's meeting.
So we do think we could see 25 bips increase this in another week here.
So we've been saying all along that if they do raise, it's going to be small and gradual. So,
right.
Looks like they'll be doing that. So.
Right.
Then also this week, light economic week, NFIB reports their consumer small business sentiment, which Greg, I know you're on the national board of.
I am.
And,
yes, matter of fact, I am. Those are great numbers and a lot of great data on the NFIB website.
Yeah. And then Friday, the retail sales report comes out, so we'll see how Black Friday and then Cyber Monday turned out. So
okay, and we like a little holiday shopping to take place around here, right?
Very good for the economy.
Yeah, sure. Well, in all the shopping and holiday season that's starting to build up, one of the questions we keep getting about is interest rates. Trey, I think we had some different clients email us.
Definitely, we've gotten several emails, and to note that we do listen and read your emails.
Do. Yeah, we appreciate those.
Several clients have been asking about interest rates. How does that impact their portfolio? How does that impact their personal lives? And Bobby's point about the Fed coming up, if the Fed's raising rates, how will that impact their investments or the rest of their lives? What we're watching right now is very interesting. So the short end of the yield curve. So what the yield curve is, that's where the short end, 3 months, 1 year, versus the long end, what rates are. And historically, the short end obviously has lower rates than the long end.
Right.
And the Fed really directly impacts the short end of the yield curve. And then supply and demand forces inflation expectations, interest rate expectations get the long end. So we've seen recently that the short end going up, but the long end kind of staying flat. And so, your mortgages are priced off the 10-year. Most corporate bonds are priced off the long end 10-year. The Fed would really like to see, the whole yield curve move up. So since the beginning of the year, the short end, I don't want to get these numbers right, the 3-month has gone up 21 basis points from 0.2 to 0.23, clearly pricing in a 25 basis points increase in the Fed.
Right.
But the 5-year has gone from 1.61 to 1.71, only 10 basis points. So it's actually moved less than half of what a 3-month.
Right.
That's telling you that the market expects that if the Fed does raise rates, it's going to be slow because you're not going to invest for the long end. The long end prices in future rate hikes. It also is telling you the supply and demand imbalance.
That's well said. Okay, yeah.
And so an interesting article that Greg brought to the group last week from Bloomberg about the supply of treasuries next year that could be holding rates
That's
down.
very important.
So several experts, the big market participants, are expecting the U.S. Treasury to put out around $400 billion worth of debt. So when the government goes into debt, they issue treasuries. That's what the long-term bonds are. And so the Federal Reserve is buying $216 billion of that $400 billion. That's leaving less than $200 billion for the market to buy.
Right.
Now, why does that matter? Because if there's less supply than historically, the same amount of demand, you have the price and rates go down. So that could hold the long end of the rate down. Also, the strong dollar, you're going to see European buyers come in, again, holding the long end of the rate down. And so that's how you can say short rates go up, the Fed raises rates, doesn't impact your portfolios negatively because you have more exposure to intermediate to long, doesn't impact your mortgage rates as much because that's more tied to long rates. So you can see the Fed losing a little bit of control of the market in terms of really the interesting thing is supply and demand versus the forcing up of the short-term yield curve. We might see a flattening, probably not an inverted,
Right.
but it's something we're watching very closely.
Right. But that also explains why we've got bond positions in the portfolio.
Exactly.
Right. Yeah, that supply and demand will play a key role in that.
Precisely, which is why you really want to watch government debt deals because that produces supply.
Right.
And so that's why, we watch all parts of the market.
Sure. Okay. All right. Well, from the beginning of the year, we've talked about interest rates and the impact that they could have. So far we've been on target on that. Another one that we've been on target has to do with energy and oil prices. Actually, we had a great debate this morning about OPEC versus the frackers here in the United States. Good old USA.
Right.
So talk about that just a little bit.
Happy to, Greg. Greg used a great phrase this morning. It truly is an economic war between the two.
Right.
And we said on the vlog a couple of weeks ago, Trey pointed out for you that OPEC would have an upcoming meeting on production. That did occur. And as he pointed out this morning was correct. They just pretty much took the production targets off.
Right.
If you were used to that in the past, we're going to produce this, we're going to produce that, off the table. It's just no production part, so they're throttling down.
Yeah.
What we wanted you to know on the vlog this morning is the United States, however, in terms of production, creating more of a glut, price continues to drop. We're as much or more of the problem than they are. And that may have gotten lost a little bit in a lot of the discussion of OPEC. There are three reasons for that primarily. The frackers are not coming offline. A lot of oil analysts would have thought with the OPEC production they would have done that. They haven't.
Yeah.
And the reason is they have to keep the cash flow going. That's first. Secondly, the other thing you have to remember about the frackers is in oil and gas, you have what are called futures contracts many times. People will lock in production at a certain level. A lot of these frackers locked in 3, 4, 5 years ago, price production much higher than the price is now. So they're still insulated in pumping.
Still making money.
Exactly, still making money. And then third and finally, and we find this very interesting, 4 or 5 years ago, several of the larger oil companies went into the Gulf with a lot of mega projects, deep water. They paid for those in cash, and the pipeline infrastructure is already in place. So in 2016, those are about to turn on too, because their marginal cost is really absorbed. They could produce it, to sort of give an absurd example, 2, 3, 4 cents per barrel, still make money. So in 2016, we see our own production staying the same, but probably going up. So if Greg called for a very low oil price a year ago, that dynamic is really happening, and it's not going to abate in 2016. We just hope the consumer comes back.
We had thought that we'd see gasoline prices as low as $1.65. I've seen it down in that range depending on which part of the country you're in.
Yes.
So I think in our area we're seeing around $1.75. Everybody agree with me on that?
It's not going to stop.
No,
it's not going to stop.
So we still stick with that forecast. And so if you think about it, the consumer pulls up, they pay less at the pump. Interest rates stay fairly stable, even though we've got a slight increase. It's showing confidence in the overall economy and may get some people off dead center to make a decision. We're starting to see the good USA economy stand on its own 2 feet and hopefully get out of central bank land, as I like to call it, and just really good old economics come back to that. So on that note, we appreciate you watching. Hopefully this has been very invaluable to you, and we're going to keep our eyes on your portfolio, keep you updated, and you continue to communicate with us about what you'd like to hear on this vlog. Talk to you later. Thanks.
More information at fiplanpartners.com. Securities offered through LPL Financial, member FINRA, SIPC.